If you own silver right now, you've probably felt the emotional whiplash over the past few weeks. One day the headlines say silver is breaking out. The next day it's warning you this move is already over. Some channels are calling this the start of a generational bull market. Others are saying retail is late again and about to get punished. When narratives get this loud, it usually means clarity is in short supply. So today we're going to slow this down. No hype, no fear. Just a calm, data-driven look at what silver is actually doing, what the numbers support, and what they don't. By the end of this video, you'll have a clearer framework for how to think about silver right now. Whether you already own it, are thinking about adding, or are simply trying to understand the risk. This is Financial Briefing. On this channel, the goal is not to tell you what to believe. It's to help you think more clearly when markets get noisy. Before we dig into the current setup, let's start with a quick scorecard because accountability matters. Last summer, when silver was trading around $22, we said the risk-reward favored patience rather than chasing downside. At the time, sentiment was extremely negative and real yields were near local highs. Our view was that most of the bad news was already priced in. Silver didn't explode higher immediately, but it stopped going down, and over the next 6 months, it rallied more than 30%. In early January, when silver pushed above $26, we said something less popular. We said the move was constructive, but short-term momentum was stretched, and a pullback would not invalidate the trend. Within weeks, silver pulled back into the mid-24s before stabilizing and moving higher again. And more recently, as silver approached $30, we said volatility was about to increase, not collapse, increase. That call is held up. Daily ranges are wider, sentiment is more emotional, and price swings are faster in both directions. Those weren't perfect calls, but they were grounded in data and probabilities, not emotion. That's the same approach we're taking today. Now let's start with the first data point that matters most right now, price itself. Silver is currently trading between roughly $30 and $33 an ounce. That matters because this is a level silver has not held consistently since the early 2010s. The last time silver spent meaningful time above $30 was during the 2011 run, and before that, briefly in 1980. But context matters. In 2011, silver moved from under $20 to nearly $50 in less than 9 months. That was a parabolic move driven by speculative leverage, collapsing real yields and extreme retail participation. This move is different. Silver took nearly 2 years to grind from the low 20s into the low 30s. That slower pace matters. What it means is that this rally has been built on accumulation rather than panic. Markets that move gradually tend to be more durable than markets that spike vertically. What it does not mean is that silver is immune to pullbacks. Even strong trends correct. In past cycles, silver regularly pulled back 15 to 20% without breaking the larger structure. At current prices, that would imply potential dips into the mid to high 20s without invalidating the trend. So price strength is real, but it's not a straight line. The second data point is demand, specifically the split between industrial demand and investment demand. Roughly 55% of global silver demand comes from industrial uses. That includes electronics, medical applications, solar panels, and increasingly electric vehicles. In 2024, global industrial silver demand reached an estimated 600 million ounces, the highest level on record. That's important because industrial demand is relatively insensitive to short-term price fluctuations. Solar manufacturers don't stop producing panels because silver moves from $28 to $32. What this means is that silver now has a stronger fundamental demand base than it did a decade ago. The energy transition is not a theory anymore. It's showing up in consumption numbers. What it does not mean is that industrial demand alone can drive prices infinitely higher. Industrial demand provides a floor, not a ceiling remover. Investment demand is the other side of the equation, and this is where things get interesting. Despite higher prices, silver ETF holdings have only recently begun to rise. For much of the past year, ETF holdings were flat or declining, even as prices moved higher. That tells us the rally was not driven by broad speculative inflows. Historically, the most explosive silver rallies happen when investment demand accelerates rapidly on top of strong industrial demand. We're not fully there yet. That's constructive, but it also means this move is not fully confirmed. The third data point is supply. Global silver mine production has been relatively flat, hovering around 800 million ounces annually. Most silver is produced as a byproduct of mining for other metals, which limits how quickly supply can respond to higher prices. That supports higher long-term prices, but it's not the full story. At higher prices, recycling increases. Scrap silver from electronics, jewelry, and industrial processes becomes economical. In previous cycles, recycling has acted as a pressure valve, increasing supply just as speculative demand peaks. What this means is that silver supply constraints are real, but they're not absolute. They support higher prices over time, not straight-line moves. Taken together, these three data points paint a picture that is constructive but not euphoric. Now let's talk about the bullish case, calmly and realistically. The first bullish argument is macro alignment. If inflation remains sticky while growth slows, real yields could drift lower even without aggressive rate cuts. That environment has historically supported precious metals, and silver tends to outperform gold when investors move out the risk curve. Second, industrial demand continues to surprise to the upside. Solar installations remain strong, grid investment is increasing, and silver usage per unit is declining slower than expected. Third, investment demand could re-enter more forcefully. If institutional investors increase allocations through ETFs or futures, silver's relatively small market size means flows can move price quickly. Fourth, positioning is not extreme. Compared to prior peaks, speculative positioning remains moderate, leaving room for additional buying without immediate overcrowding. Put together, this bullish scenario is plausible, not guaranteed, plausible. I assign roughly a 25% probability that silver holds above $30 and works its way into the high 30s over the next 12 months. But silver is famous for punishing one-sided narratives, so let's talk about the bear case. First, real yields could rise again. If growth remains resilient and inflation cools faster than expected, real rates could move higher, which historically pressures silver. Second, the dollar could strengthen. A renewed bid for dollar assets would be a headwind for commodities broadly. Third, speculative excess could build quickly. Silver attracts momentum traders. If positioning becomes crowded, small macro disappointments can trigger sharp sell-offs. Fourth, industrial demand is cyclical. A global slowdown would reduce electronics and solar demand even if long-term trends remain intact. That bearish scenario doesn't require a crisis. It just requires normalization. In that case, silver could easily retrace back toward $26 or $27 without breaking the long-term thesis. I assign that outcome roughly a 30% probability, which brings us to the most likely outcome. The middle case is continued volatility with higher lows. Silver trades between roughly $28 and $36 over the next year, frustrating both bulls and bears. Pullbacks feel scary, rallies feel convincing. Neither side gets full confirmation. That's the environment silver thrives in, and where disciplined investors do better than emotional ones. I assign that scenario roughly a 45% probability. Now let's step back and put this into historical context. The closest comparison to today is not 1980 and it's not 2011. It's the 2004 to 2006 period. Silver broke out of a long base, moved steadily higher, then entered a volatile consolidation before the eventual blow-off years later. The similarity is a structural shift in demand combined with gradual investor recognition. The difference is leverage. Today's market is more regulated, with less systemic leverage and fewer forced liquidations. That reduces tail risk in both directions. It makes collapse less likely and mania less immediate. Looking across markets reinforces that picture. Gold is holding near all-time highs around $2,300. That's supportive. Silver rarely collapses when gold is strong. The dollar index is hovering near 103. That's neutral. A sustained break below 101 would be bullish for silver. A move above 105 would be a headwind. The 10-year yield around 4.3% is the pivot. Lower helps silver. Higher pressures it. Positioning data supports this balanced view. Commitment of traders reports show managed money net long, but not at extremes. Banks remain net short, as usual, but not aggressively so. Institutions are engaged, not euphoric. So what am I actually doing? My total silver exposure is about 8% of my portfolio. That includes physical and paper exposure. If silver pulls back toward 28 without a macro deterioration, I add incrementally. If silver spikes above 37 rapidly, I trim. My stop loss on paper positions sits near 26. Below that, the thesis changes. My take profit zone starts in the high 30s. Not advice, just my framework. What I'm not doing is panic buying. I'm not consuming fear-driven content, and I'm not assuming collapse or salvation. This week, I'm watching inflation data, the dollar index, and ETF flows. Those will tell us whether this move is being confirmed or questioned. So here's the takeaway. Silver's move is real, volatility is rising, fundamentals are supportive but not explosive. Discipline matters more than conviction. If you value calm, probability-based analysis, subscribe to Financial Briefing. That's what we do here. Stay sharp. One thing I want to expand on, because it tends to get lost in short-form commentary, is why silver feels so emotionally charged compared to other assets. Silver sits at an unusual intersection. It's part monetary metal, part industrial input, and part speculative vehicle. That combination creates feedback loops that don't exist in gold, equities, or even most commodities. When silver moves, it pulls in three different types of participants at once. You have long-term holders who see it as insurance, You have industrial users who care about supply security more than price, and you have short-term traders who are attracted to volatility. When those groups overlap, price action becomes exaggerated. That's why discipline matters more in silver than almost anywhere else. If you zoom out to a weekly chart, silver does not trend smoothly. It surges, stalls, pulls back hard, and then resumes. Anyone who's been in this market long enough has lived through periods where silver drops 20% in a matter of weeks, only to recover and make new highs months later. That history is uncomfortable, but it's also instructive. This is where expectations matter. If you're holding silver expecting linear progress, you're almost guaranteed to be disappointed. If you're holding silver as part of a diversified framework, with predefined risk and time horizons, the volatility becomes tolerable, even useful. Let's talk a bit more about positioning, because this is where a lot of narratives break down. The Commitment of Traders report shows that managed money net long positions have increased, but they're still well below the extremes seen in 2011 or even in the 2016 rally. That suggests this move is being participated in, but not overcrowded. Commercial hedgers, which include banks and producers, remain net short, as they almost always are, but their short exposure relative to open interest is not extreme. That matters because in past blow-off tops, commercial shorts were aggressively positioned, often coinciding with peak retail enthusiasm. Right now, enthusiasm exists, but it's uneven. Some corners of the internet are euphoric, others are skeptical. That tension is typical of a middle phase, not an end phase. Institutional behavior also supports this view. Large funds are increasing exposure gradually, not rushing in. Position sizing is cautious. That's consistent with an environment where silver is being reevaluated, not blindly chased. Now let's ground this back into actionable thinking. Because analysis without a plan is just commentary. When I think about silver, I think in scenarios, not predictions. If silver continues to trade above $30 and holds higher lows while real yields drift lower, I remain comfortable holding my current allocation and adding on weakness. I don't need confirmation from headlines. I need confirmation from structure. If silver breaks below 28 decisively while real yields rise and the dollar strengthens, I reduce exposure. That doesn't mean silver is dead. It means the timing is wrong. If silver accelerates rapidly into the high 30s without a corresponding shift in macro conditions, I trim. Not because I think it can't go higher, but because parabolic moves in silver rarely sustain without digestion. That framework keeps emotion out of the process. It's also worth addressing a common misconception, that silver must outperform gold to be working. Silver often lags gold early in precious metals cycles. Gold tends to move first, absorbing monetary demand. Silver follows later when investors move further out the risk curve. That's exactly what we've seen. Gold broke out first. Silver is catching up. The gold to silver ratio is still elevated compared to long-term averages. Historically, that ratio compresses during silver outperformance phases, but that compression doesn't happen overnight. It unfolds over quarters, sometimes years. So when you hear claims that silver is supposed to be at $50 already, ask compared to what time frame and under what conditions. Now let's talk about risk, because ignoring it is how people get hurt. Silver is volatile. At $32, a 20% correction is roughly $6. That's not hypothetical, it's normal. If that kind of move would cause you to abandon your plan, your position size is too large. This is why allocation matters more than conviction. A 5 to 10% allocation allows you to stay rational. A 30% allocation almost guarantees emotional decision-making. That's not a judgment, it's math and psychology.